The silver market is entering one of the most fascinating periods investors have seen in years, and right now the atmosphere inside coin shops tells a story that charts alone simply cannot explain. Across the country, dealers are watching waves of people walk through their doors carrying old silver stacks, inherited collections, bullion bars, junk silver bags, and even rare historical coins. Some are cashing out after years of holding. Others are trying to survive rising living costs. And many are simply reacting to the emotional roller coaster that precious metals always create whenever prices make aggressive moves. One major bullion dealer recently announced something that immediately grabbed the attention of the precious metals community: a massive silver giveaway featuring 2 monster boxes of silver coins. Promotions like this are not just marketing. They reflect how intense public interest in silver has become again. Whenever companies begin heavily promoting silver products, it usually means retail demand is heating up. Social media conversations are growing louder, and everyday investors are paying attention to the market once more. At the same time, many longtime precious metals channels are seeing huge growth in audience numbers. Thousands of new subscribers are flooding into gold and silver communities online. That matters because retail investor sentiment often becomes a major driver in the precious metal space. When fear rises, inflation dominates headlines, or economic uncertainty spreads, average people begin looking for tangible assets. Silver and gold have always benefited from that behavior. But what is happening inside coin shops right now may surprise many viewers. Dealers are not necessarily reporting a flood of buyers. Instead, many shops are experiencing something completely different. They are seeing an overwhelming number of sellers. In some cases, shop owners claim that for every 1 buyer, there may be 8 or even 10 sellers walking through the door. That ratio alone says a tremendous amount about current economic conditions. The reason is not always panic. In fact, many people selling silver today are not abandoning the metal because they lost faith in it. Some are simply taking profits after strong price increases. Others miss selling opportunities when prices temporarily spiked and are now choosing to exit while silver still remains elevated compared to previous years. And unfortunately, many people are selling because life has become expensive. This is one of the most overlooked realities in the precious metals market. People often imagine silver stackers as investors who endlessly accumulate metal without ever selling. But the truth is far more practical. Families face taxes, emergency repairs, rising fuel prices, rent increases, medical bills, and unexpected expenses. In difficult economic periods, silver becomes a financial backup plan. That is exactly why many people buy it in the first place. Coin shop owners understand this reality better than almost anyone. When silver prices rise sharply, their inventory often explodes overnight. Cases become packed with silver rounds, government bullion, constitutional silver, commemorative coins, and collector pieces. Items that were nearly impossible to find during low-price periods suddenly flood back into the market. Dealers describe it almost like a tidal wave. Months of hidden inventory suddenly emerges from safes and storage boxes. Interestingly, this creates both opportunities and problems for dealers. On one hand, full display cases attract customers. Buyers love seeing variety. Nobody wants to walk into a coin shop and stare at empty trays. A healthy inventory creates excitement and confidence. On the other hand, too much inventory can create serious pressure on cash flow. Precious metals businesses survive on liquidity. If they tie up too much money in silver during a falling market, losses can mount quickly. That balancing act is incredibly difficult. A dealer wants to continue buying from the public because refusing customers damages trust and reputation. Many investors specifically remember which shops kept buying during volatile periods and which shops stopped accepting silver entirely. That loyalty matters. A customer who feels supported during a market panic is likely to return again and again. However, there is another side to the story. Dealers also face real risks when prices move violently. If silver drops several dollars per ounce in a single day, inventory purchased at higher levels suddenly becomes dangerous. Margins in the bullion business are often thinner than most people realize. When a shop buys silver from the public, pays employees, covers insurance, rent, security systems, utilities, taxes, and refining costs, even a relatively small market move can dramatically impact profitability. This is why some investors misunderstand dealer premiums. During strong markets, many sellers become frustrated when shops offer under spot price or apply larger spreads, but businesses must protect themselves from volatility. A coin shop that overpays during a falling market can quickly find itself underwater. If silver falls $2 or $3 overnight, those losses become very real. At the same time, precious metals pricing never behaves perfectly according to traditional rules. Investors are often told that a weaker dollar automatically means stronger metals, or that economic instability guarantees rising gold and silver prices. Reality is far more complicated. Markets frequently move against expectations. Sometimes metals fall during inflation scares. Sometimes they rally despite rising interest rates, and occasionally prices appear disconnected from logic entirely. This is why so many investors believe unseen forces influence the market behind the scenes. Accusations of manipulation have existed in the silver market for decades. Whenever silver appears ready to break out, sudden sell-offs often emerge. Sharp declines during periods of strong demand fuel endless speculation. Whether manipulation exists on the scale many claim is constantly debated, but one thing is undeniable. Silver is among the most volatile major assets in the financial world. Recently, silver briefly approached extremely high levels before pulling back sharply again. That pattern has become familiar. Every time silver seems ready to escape into a new price range, resistance appears. Traders who have watched the market for years often say silver behaves like a spring compressed beneath enormous pressure. It surges violently upward, only to snap backward just as aggressively. Some analysts believe geopolitical developments are partially responsible for recent weakness. Whenever global tensions cool or major diplomatic talks appear successful, safe haven demand for metals can soften. Investors who bought gold and silver out of fear may rotate back into equities or riskier assets if they sense stability returning to the global economy. But predicting short-term moves in precious metals is notoriously difficult. Even veteran dealers admit they rarely know exactly why prices rise or fall on any given day. Instead of obsessing over daily headlines, many longtime stackers focus on discipline. They follow consistent buying plans, avoid emotional reactions, and think in years rather than weeks. That mindset becomes especially important when considering gold to silver trades. Many investors constantly debate whether it makes sense to swap silver into gold after strong silver rallies. In theory, when silver dramatically outperforms gold, converting some holdings into gold can preserve gains while reducing volatility. But timing those trades perfectly is incredibly challenging. Coin shops are currently seeing strong interest in fractional gold pieces. Smaller denominations, such as 1/10 ounce and quarter ounce coins, remain popular because they are more affordable for average buyers. Full ounce gold products often disappear quickly whenever prices stabilize or investor demand rises. Meanwhile, silver collectors continue hunting for unique opportunities hidden within dealer cases. One area gaining attention involves modern commemorative dollars. Many investors overlook these coins entirely, yet some contain identical silver content to classic Morgan and Peace dollars. For years, these commemoratives were struck in 90% silver before newer versions transitioned into higher purity compositions. That transition surprised many collectors because governments historically reduce precious metal content over time rather than increasing it. Rising mint prices on modern products likely reflect those changing metal compositions, combined with growing production costs. But perhaps the most fascinating aspect of the precious metals world is the deep historical connection between silver and money itself. Many modern investors forget that silver literally shaped the origins of the word dollar. Centuries ago, massive silver discoveries in Central Europe led to the creation of large silver coins known as thalers. Over time, the pronunciation evolved into dollars, eventually influencing currencies around the world. These early silver coins remain highly collectible today. They represent a bridge between ancient monetary systems and modern finance. Some were struck using primitive roller press technology, leaving off-center designs and imperfections that collectors now consider charming historical fingerprints. Studying these coins reveals how deeply silver is embedded in human civilization. And this is where the hobby side of precious metals becomes just as compelling as the investment side. Inside coin shops, extraordinary treasures continue surfacing unexpectedly. Dealers regularly encounter coins so rare that even experienced collectors may never see another example again. Pot coins are among the most fascinating discoveries. These experimental pieces were created by mints to test potential designs before official production. Some feature stunning high-relief artwork and intricate symbolism that never reach circulation. Because so few examples exist, they become legendary within numismatic circles. Early coins generate similar excitement. One of the most famous examples remains the three-legged buffalo nickel, created after over-polishing damaged a coin die. The missing leg transformed an otherwise common coin into a valuable collector's item worth thousands in high grades. Stories like these capture the imagination because they turn ordinary pocket change into hidden treasure. Hudgeon becomes critically important in these markets because counterfeits and altered coins exist everywhere. Experienced numismatists rely on microscopic die markers, surface textures, strike characteristics, and unique defects to separate genuine rarities from fakes. Sometimes even bizarre details, like tiny die imperfections resembling unusual shapes, become essential clues. Another famous rarity, the 1909's VDB Lincoln cent, continues dominating collector demand more than a century after its release. The initials of designer Victor David Brenner sparked public controversy, causing the mint to quickly redesign the coin. As a result, original examples became iconic key dates within American coin collecting. Rare Morgan dollars featuring doubled dies, proof-like surfaces, and mint errors also remain highly sought after. What makes these coins extraordinary is the combination of rarity, artistry, and historical significance. Some pieces survived economic depressions, wars, bank vault meltings, and generations of circulation before finally reaching collectors in astonishing condition. The modern precious metals market, therefore, exists on multiple levels simultaneously. To some people, silver is simply insurance against inflation. To others, it is a speculative asset capable of explosive price movements. For collectors, it represents history, art, craftsmanship, and the thrill of discovery. And for businesses operating coin shops, it is a constant battle between opportunity and risk. What makes the current moment so interesting is the sheer emotional complexity surrounding silver right now. Optimists see tightening supply, growing industrial demand, expanding solar production, geopolitical uncertainty, rising debt levels, and currency concerns as bullish long-term factors. Skeptics point to repeated price failures, volatile corrections, and economic slowdowns as reasons for caution. Yet despite all the arguments, silver continues attracting attention like few other assets can. There is something psychologically powerful about holding physical metal in your hand. Unlike digital assets or stock certificates, silver feels permanent. It carries weight, texture, and history. That tangible quality creates emotional attachment far beyond normal investing. And perhaps that is why coin shops remain such fascinating windows into economic reality. Charts show prices, headlines show narratives, but coin shops show human behavior. They reveal fear, optimism, desperation, opportunity, and history, all sitting together inside a glass display case. Today, those cases are fuller than they have been in years. Dealers are buying heavily, managing risk carefully, and navigating one of the most unpredictable precious metals environments in recent memory. Some investors are selling to survive. Others are buying because they believe the real move has not even started yet. No one knows exactly where silver goes next. It could surge higher if inflation fears intensify or if industrial demand accelerates further. It could pull back sharply if economic conditions stabilize or if traders rush toward other assets. Both scenarios remain possible because silver has always been a market driven by emotion as much as fundamentals. But one thing is clear, interest in precious metals is growing again. Online communities are expanding rapidly. Retail investors are paying attention, coin shops are busier, historical coins are resurfacing, and conversations about wealth preservation, inflation, and financial uncertainty are becoming louder every single day. For longtime stackers, none of this feels surprising. Silver has always moved in cycles of neglect and obsession. For years, it can sit quietly ignored by mainstream investors. Then suddenly, almost overnight, everyone starts talking about it again. And judging by what dealers are seeing right now, that conversation may only be getting started.